still hot, but with signs of improvement. Ukraine is still at war and affecting energy and food prices. Talk of a recession is heating up. Both stock and bond markets continue to test investor discipline. Is it better for the Fed to pull the Band-Aid off quickly or slowly? How long will bear markets typically last? That and more in the third quarter 2022 quarterly context webinar. Welcome to the quarterly context webinar for friends and clients of the advisor group. I'm Greg Patterson, CEO. For those not familiar, the advisor group is a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realm, their fiduciary or employee support efforts, and their communities through their foundations and endowments. To complement the strategic work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns, and other elements to help our institutional and personal wealth clients stay more relaxed by being informed and making, therefore, better decisions towards your goals. It should last about 20 minutes, maybe a little more, and we'll circulate a video link later if you'd like to share with others or review some part of it again. If you have any questions, please plug them into the question box and we'll address them as we go along or at the end. A number of topics we'll cover today with a little extra focus on what's going on with markets, given that we're still in a very bumpy time. And so let's go ahead and get started. Of course, we always want to remind everyone to find and focus on that intersection between the things that matter to you and the things that you can control. Markets can't be controlled. Your response to markets and how you get support in making smart decisions around your needs relative to market volatility or market changes is something that you can control. In terms of headlines, continued talk of inflation, dollar strength, market picking up a little speed and then cooling again. And then since the end of the third quarter, a few very strong days as well. Mortgage rates have risen, housing prices remain relatively high, so that's a bit of a conundrum for those that are hoping to buy as other economic dynamics are challenging. And the Fed raised rates a number of times given the inflation situation. We'll cover some of these topics in more detail. What you can see here in this 25-year chart we've added, the current downturn in markets is not uncommon and so far quite a bit smaller than the biggest downturns of the last 15 or 20 years or so, but still certainly uncomfortable. And when you have rising rates, that hurts both bonds and stocks, so there's really feels like there's no place to hide. And it wouldn't be unusual at this stage if things got a little better before they, a little worse before they got better, but that's very unpredictable. And the key thing is to focus on your goals and don't make decisions that will harm your long-term goals just because of short-term concerns. A couple key numbers that you might find interesting. The Fed, as mentioned, did raise rates by 0.75 points 3 times in the last year. That is the first time ever that there have been that many hikes consecutively in this time frame, which is a signal that the Fed is really trying hard to fight inflation to prevent inflation from doing more harm later. The inflation currently has come down a little bit to 8.2 annualized, and the expectation is that in 2023 it will come down further, 3.1, and coming down further in terms of expectations in the years soon after that. Returns again have been weak. Value continues to outperform growth year to date, continuing a reversal. However, in this last quarter, growth did beat value a little bit. and the dollar remains strong. That creates some complications for the economy and some advantages depending on what part or sector you're in and how much exporting you do. And unemployment remains at a very low level, which some would say you can't really have a true recession if unemployment stays low. It's expected that unemployment will go up. Given what the Fed's doing with rates, it may force a recession at some level, and that would lead to some increase in unemployment. Here's what the market looked like. Still a lot of red in the short term. The US market down 5% or 4.5% for the quarter, down almost 18% for the year. International a little bit worse in quarter and year, emerging a little bit worse than that, and real estate somewhere between US stocks and international. The bond markets, this is what's a little bit disconcerting for some when we people generally think of bonds as being a cushion in bad markets. They have been a little bit relative to stocks, but on an absolute basis, still pretty significantly down for the year, with US bonds, broad market down almost 15%. This is because of those really heavy Fed rate hikes, and that as rates go up, it creates higher yielding new bonds, but then because existing bonds in the market are relatively less attractive, their prices drop so that they essentially are purchasable at a similar equivalent value to the new bonds that are coming on the market. So that's why bond prices drop. The good news is in the long run, that helps bond yields go up, and as new bonds get added to portfolios, your bond returns will increase, and this will that can have actually a beneficial long-term effect. What we'll point out here, and also point out again later, is that if you look at the 5 and 10-year returns, they are still ahead of long-term returns and still ahead of the projected returns. The projected returns we use in the planning process for personal wealth clients and for foundation endowment planning and so forth, still ahead of the game. So keep that in mind. That can be very comforting, even though the short-term returns here are very negative, although not nearly as bad as some other years in the past decade or so. So is it a recession? Will it be a recession? When will stocks start to make their comeback? The Fed is not afraid to trigger a recession in order to get inflation under control, and it's likely that some level of recession will happen, and probably by sometime in 2023. That doesn't mean, however, that it will be an extreme recession. And there are some pundits, of course, who, in theory, could be right, but may just be trying to attract media attention by saying that there is an extreme recession in the works. There are a number of things that point in a direction that's different than that, but in terms of not being an extreme potential recession. But some level of recession is possible and wouldn't be surprising or uncommon given the dynamics. What's interesting as well, if you think of returns in relation to recessions, market returns tend to begin to recover before people know that we're in a recession. Studies show, and you can see some of the numbers here in the table, a number of months, most commonly, the recession, by the time the recession is announced, because a recession is really defined based on a number of factors and a decision by a group of economists after there's enough data. And by the time they have enough data, oftentimes the recession is, okay, it's already underway and markets have already started to recover because they're anticipating the breakthrough from the recession before that news comes out. So no clear picture. We'll show you some numbers later about what a typical bear market, how long it typically lasts. But I think it's safe to say we're somewhere in this bottom of the U. Just not quite clear if we're nearing the bottom or somewhere approaching the bottom or starting to work our way out. But don't be surprised if there's a little more pain before we start the real upswing. If we look at the bear market section of this chart, first you can see bull markets are bigger, stronger, and last longer. Bear markets are shorter and painful and oftentimes steep, but don't last nearly as long. The average bear market is 14 months, and the average bear market return is a negative 33% return. Currently, we've been in the bear market for about 9 months. And if we look at the broad US market, large, medium, and small stocks, if we start from the beginning of the year until yesterday, it's down about 23%. So not as long so far, nor as deep as the average. And if we go just to the end of last quarter, about a 25% drop. So already a little bit of recent recovery. What actual recovery would it take if we're looking at, relative to the end of the third quarter? If the recovery would happen in 1 year, it would take about a 36% return. If it were to happen over 2 years, it would take about a 17% return per year, 3 years, 12% per year, 4 years, 9% per year. So getting back to that peak, there's a number of reasonable scenarios where we can see that happening. One thing we will remind you of, though, is that, and we'll discuss this in a chart again later, the getting back to the peak would be getting back to what is considered by many to have been an artificial high, overvalued stocks after more than a decade of excessive stimulus programs to reduce the risk of having a much worse economic environment after the global financial crisis and the COVID crisis. So getting back to the top would actually, in some levels, if it were done based on without overly stretching valuations, would actually be getting to new highs even before we get to the previous high, if you consider that the past high may have been somewhat artificially inflated. If we look at this table here, in the bear markets, you can see the average bear market for stocks is about 20 months, right? So at the moment, again, we're at about 9 months. There are a number that are a lot shorter than 9 and some that are a lot longer than 9. So there's a lot of different scenarios that could happen here. Hopefully this helps you begin to feel like there is an end to this and a light at the end of the tunnel. A lot of you have been through much worse markets and much longer, more painful scenarios than this. Again, not that it's over, but hang in there. We'll get through it together. Again, it's also important to note that we're ahead of, if you look at stocks over the last 10 years, we're still ahead of the projected returns in and the long-term averages in most cases, both 10-year US and a bunch of cases still for the 10-year global numbers. So having an overall US stock market that is between 8 and 12% for the broad market here, or roughly in the 7% range for international stocks, that's a pretty good situation to be in, and that is consistent with the numbers roughly that we have been using for planning for clients. So if you just measure from the high watermark, that can make you feel worse and farther off track than if you really rely on the planning process. Again, this relates partly to some inflated stocks. That is part of why the current downturn feels more painful than it should. So on that note, if we look at the returns over the last number of years and how in the last several years there was an especially strong boost from the bottom of the COVID dip up to the peak at the end of 2021, this is where the most inflationary effect on stocks, not inflation in terms of purchasing prices, but overinflated stock markets occurred. So if we were to, for example, chop off the top of that mountain and just draw a line across from roughly when the heaviest part of the overvaluation period started and went straight across as if there were no return to where we are about now, that equates to, from the bottom of the global financial crisis, if we draw a straight line that, that's about a 7% return, which is about what the projected return was. So at some level, we are just getting back to where we should be. And if the market cools further, then it might be a little bit more like a normal correction rather than a correction of this overinflated stock market. So the big challenge for the Fed right now is whether to pull the Band-Aid off slowly or quickly, and they have chosen to pull it off quickly. We think that's the right decision. It's more painful in the short run. It pushes rates up. That is more damaging in the very short run to bonds and stocks, but it prevents the type of scenario where high inflation and potentially overheated growth can do more damage to an economy and lead to a more systemic problem in the long run and damage long-term returns more than having a fix now and getting to a more normal environment faster. It's not comfortable, but it is almost assuredly the better long-term decision. So quick history here to where we have been and where we are. So all that stimulus from the global financial crisis and the COVID was really about trying to prevent depressions. Those scenarios were pretty bad. Global pandemic, unprecedented situations. The global financial crisis was a global total financial crisis that could have been much, much worse if serious stimulus had not been put in place. So that's the good news. Depressions were averted. The problem is that that does have some side effects now. Led to overinflated economy and markets, and that led to now finally longer than normally would have taken, but high inflation. So really, in a lot of ways, that's a small price to pay for avoiding a depression or multiple depressions. So with the high inflation, the Fed has really wrapped up rates. One of the key reasons they're doing that as well is that a key dynamic in inflation is what the average consumer believes will happen with inflation. If they have some confidence that the Fed is acting, even if it's painful, that inflation will get reined in, people will behave differently and in a way that is more beneficial for the economy in the long run. And the other kind of short-term dynamic that happens is if stocks are cooling and new bonds are coming on that have a higher yield, it makes stocks a little bit less attractive in the short run, and that kind of compounds the market dynamic if people are leaning towards those new bonds rather than holding their stocks. I'm not speaking of our clients and the people we advise, but just the market more broadly. So that pulls some upward pricing pressure away from stocks and makes it a little bit easier for them to cool. Some of the good news is that this entire problem is not a fundamental structural financial systemic problem like the global financial crisis. So that's good news. A lot of what's happening is because of the hand of the Fed to try to get something under control before it becomes a bigger problem. The supply chain dynamics and the Ukraine war, those elements, hard to say when, but will improve. Supply chain dynamics are already starting to improve in some sectors. Hard to predict when Russia will fall in line. So that's a tricky one. But and additionally, wage growth reductions are place less inflationary pressure, and if unemployment, which is likely to go up, still stays relatively low, that would lead to a softer landing. But that's a pretty important variable that people will be watching in terms of the depth of a potential recession. So there are some good, the other good news is every crisis has and creates its opportunities. As mentioned before, the planning that we do for clients already incorporates the expectation that recessions will happen. This is not a surprise. No one can predict when, but it is part of the projections. It's part of the returns. It's built in so that your planning is not thrown off. Your long-term goals should not be thrown off by these types of dynamics. And a key sort of component that in parallel with the long-term plans is how we advise clients to maintain short-term reserves, both on the personal wealth side and the foundation endowment side, as well as retirement plan participants, especially if they're approaching retirement, to try to maintain some reserves so that you can pretend like there's no bad market. If you have something to spend from, and that's what it's for, now is a good time to use those short-term reserves to spend for your spending needs. You can rebuild them later, but that's what they're there for, is to, in many cases, is to spend them while markets or stock markets are down, so you don't have to sell low and cut into your recovery in the future. Again, we've talked about how markets are above average still, and how bond returns will improve, and they're also, of course, rebalancing and tax loss harvest opportunities that you can't get those opportunities when markets are going up. So that does create an advantage, even if it might not be obvious. So with that, all of that as the big context, let's just whip through some of the details that are some of the supporting evidence for all of that. COVID cases are coming down. We're hoping this is kind of the final downward trend into a more normalized. It may never disappear, as experts expect it won't, but it may become more like a component of a flu season, a component of the flu vaccines moving forward. What's very good news in general is that the death count has come down significantly, and we're now at a level that hasn't been of daily deaths that hasn't been the case since the very beginning of the pandemic. So that is generally a good sign. Doesn't mean people don't need to be careful. This just means that the risk globally has gone down. Inflation, as mentioned, remains sticky, but it has come down a little bit. And the projections are, again, in the 2 to 3% range over the next several years. May not feel like it now, but supply chain elements have improved. There have been some price drops already in a number of sectors. You may recall like 5 or 6, 7 quarters ago when there was a huge lumber spike when everyone was doing home improvements, and we said, you know, big spikes are followed by big drops. Well, guess what? That's what happened. Lumber fell 70% in prices from its peak, and it's expected that there are other sectors of the economy and products and prices where similar drops may happen and may have sort of an acceleration of reduction in inflation over the next even year. So that's good news. Inflation is high now, but there are a lot of reasons to believe it will cool over some reasonable time frame. Again, here we can see rates ratcheting up. This is the 3/4 point rises. Still, however, even with those rises, we're below long-term averages. So some of who have never seen are seeing 6 to 7% mortgage rates and feel like that's sky high. Don't remember when 6 to 7% was a pretty reasonably attractive mortgage rate, in maybe on average before this very low rate environment that we're coming out of. Bonds. There's 2 periods, 70s, early 80s, and the current where there was big rate hikes to rein in inflation. The bonds have now dropped more as a result than it did during the 70s period. Again, that's normal. That will normalize and things will come back up, and bonds will have their recovery over time as well. Stock valuations are even more attractive now with a little bit of cooling through the end of September. So the longer they stay in an attractive range, the more likely we are approaching a period where stock prices will increase as we go back to something closer to a normal average valuation. So some good light at the end of the tunnel there. Consumer sentiment has actually improved a little bit off a 50-year plus low. People, I think, are beginning to realize that things on the horizon are not as bad as they could be. It doesn't mean things are stabilized yet, but it does mean people realizing, okay, some of the panic has worn off, and that is generally a good sign for a number of reasons. Unemployment and wages. Unemployment still hovering at a similar level, low level. Wage growth has continued to taper off a little bit, not surprising given the talk of possible recession. The yield curve has gone inverted again, which historically precedes a recession. Pretty good predictor of recession in terms of yes or no, but not a good predictor in terms of when. So this is essentially the bond market's way of expressing an opinion about the economy. Volatility has picked up a little bit, but not dramatically above long-term levels, but certainly day-to-day volatility is higher than it has been for a while, given there was such low volatility during the last decade. It feels higher than normal, even if it's not that far off of something a little closer to long-term average. In terms of the asset class corner, international stocks and unhedged bonds have been underperforming relative to US stocks and bonds over quite a number of years, and the current increasingly strong dollar has continued that pattern. Historically, that doesn't last forever. You can see the last 10 years have favored dollar holdings of international or dollar-based securities. The prior 10 years significantly favored international. So you will look at components of the portfolio and you might say, why international? Why international bonds? Why? Time will show you why. We can't say exactly when, but a number of organizations expect, because of valuations and other factors, international stocks will eventually have their turn to cycle back and provide more value to the portfolio. In terms of the 401k corner, a lot of this, just to summarize all these themes, maybe this is a good comment for everyone, but if you are a business leader and have the ability to communicate to your team or company, remind people how important it is to stay the course, not to reduce risk because of fear, and to change. People should not be changing their long-term stock bond mix just out of short-term concerns. That will actually harm their long-term goal achievement and retirement readiness. If they already have stock bond mix that's appropriate for their life stage, just encourage them to stick with it. They don't, there's no way to avoid risk. It actually, by avoiding volatility risk, you can dramatically increase inflation and retirement readiness risk. So that's a good message to remind them, is it's not a matter of avoiding risk. It's, you've got to choose which one is the risk that helps you in the long run. And volatility provides a value in the long run. Inflation does not. So helping people get over that discomfort can, a signal from you as a leader can be very helpful and powerful, and help them create a buffer from hitting that panic button. We have a webinar coming up in November that will be announced soon regarding timely tax strategies as we approach year end. So look forward to, keep your eyes out for that. We have a number of new blog posts regarding being smart with insurance, regarding how to think about fiduciary duty in your retirement plan, some of the advantages of considering a semi-retired lifestyle if you are a business owner, possibly never retiring, interesting research around what the happiest state is, and it's not always fully retired. How finances impact emotions, and information in some ways similar to what we covered today about the recession outlook. So we want to thank you for being here today. We hope this was helpful, that you gained some insight. Please feel free to share the link that you'll get as a follow-up to this with other people you care about. It may help someone prevent themselves from making a big emotional investor mistake. A lot of people would benefit from planning that would help them know that what they're doing is the right thing. When you know you have a plan and a strategy that makes sense and it's designed to manage different types of markets, it's easier for people to be disciplined. People who do it on their own or have investment help but not planning help oftentimes struggle and suffer a lot more stress during these times, and then suffer big mistakes if they do react emotionally with their investments. So you can help people by just encouraging them to view something like this that might keep them on track. So again, thank you for being here today.